Yeah. Good morning, everyone. Start recording. Yep. Okay. तो कल हम लोगों ने वी सॉ yesterday VIE variable interest entity. Okay. So anyone has any doubt on this? VIE we need to see when there is a disproportionate voting right. Voting rights. Okay. Generally, what happened? Like if any entity acquire more than 50% shares of other company, okay, so then they need to consolidate financials with other company. Okay, why we required to do it? Because like say for the company A is parent company. Company and company B is subsidiary. Okay, so in that situation, if we issue the standalone financials of company A, okay, then whatever may be the net asset of company B, it's shown in a asset side as a investment. Investment. Okay. So in that situation, the users of the financial may not get the correct idea what are the exactly the asset the company B has. Okay, because we are showing only a single line as an investment. So that's why it is mandatory that particularly for the issuer companies that they need to issue the consolidated financials. Okay, need to issue consolidate financial. Okay, so that users of the financial may get an idea what is the total asset in which form, like current asset, non-current asset, current liability, non-current liability, okay, is available with the parent company. Okay, so that's why we need to issue the consolidated financial statement. Okay, generally, I mean by default, consolidation can be happened with those company whose more than 50% voting rights. 50% voting right, more than 50% voting rights actually taken by the or acquired by the private by the parent company. Okay, so that you need to keep in mind. Exception to this, okay, we need to consolidate those company where we may not have more than 50% voting right. Voting right. Okay. But if the company fail, the other company fail, or the yeah, then we need to absorb the losses. Absorb loss. Okay. Or we are sharing residual profit. Or we are controlling the business. How we can control the business? Either more than, I mean, the major order is given by us. So if the parent company is not giving an order, okay, so that company may not survive. Given by us, or major finance given by us. Maybe it is in terms of the loan. Us. Okay. So in that situation, even though you have a disproportionate voting right or the lesser voting right, still you need to consolidate because you are driving that company. So that is basically the like the VIE and the requirement of the consolidation of the VIE. Okay. In some cases, we are not going to consolidate where we cannot drive the business. Like even though we have a 50%, more than 50% shares or the voting right, but the subsidiary is in bankruptcy. So it is basically the court order, it is driven. Okay. So that's why we should not consolidate those business entities. So it is basically consolidation is depend on the you are controlling strategy or your controlling strength of the other unit. Okay. So and the prima facie we judge the controlling strength from the whatever the voting right share available with us. Okay. But there are certain exceptions in the like the first exception where we have a more than 50% voting right, but we cannot control it. Maybe because of strict rules and regulation, maybe because of bankruptcy. Okay, so in that situation, we should not consolidate those entity. And the other exceptions is whether even if we do not have a sufficient voting right or the more than 50% voting right, but because of the business or the finance, we are going to control the other unit, other company. Okay, so in that situation, we need to consider for the consolidation. So it is mainly consolidation mainly depend on how what is your controlling strength to the other company. Okay. So primary beneficiary consolidation, once a company has established that it has a variable interest in business entity, that is a variable interest entity, the primary beneficiary must be determined. The primary beneficiary must consolidate the VI, means who is mainly impacted because of failure and the success. Okay. Who is mainly gain. Okay, so that is basically the primary beneficiary, and the primary beneficiary company need to consolidate VIE. Okay. If the situation is that if one party receive the expected residual return and the another party absorb the expected losses, the party that absorb the expected losses, they need to consolidate. So it is possible for an entity to be VIE but have no primary beneficiary and there nobody consolidate. So there may be possible, means there are 2-3 companies they invested. Okay, so no one is able to or their like losses is restricted to the their investment. So in that situation, no one need to consolidate it. Okay, one thing you need to keep in mind: consolidation can happen with the only one company. Sorry, like company A and the company B. both are like a parent company. They are driving a company C. Okay. Company A may share the losses, absorb the losses, and the company B, he is, means if there is a profit, then he need to, because of the investment is investment or voting rights, company B has high voting rights. Okay, so because of that reason, okay, so share profit is shared by company B. Company B. So as the company A need to absorb the losses, so we need to consider the company A as a primary beneficiary. Okay, why we need to consider? Because we need to first protect the losses. Okay, profit is basically the like it is a, okay, it is a I mean the reward for the success, but the losses mainly impacted. Okay, so that's why in this situation company A need to consolidate. If the situation is that 50% loss absorbed by the company A and the 50% loss absorbed by the company B. So in that situation, both have a same stake. Okay. And because of that reason, no one should consolidate. Okay. That you need to keep in mind. Consolidation can happen only with one company. I mean, the same company cannot consolidate in a two different, with a two different parent company. Okay. So that also you need to understand. Then the applicability to the private company. Okay. So US GAAP include accounting alternative guidance for how a private company recognize, measure and disclosure of a VIE. A private company include all entities except for public business entity, not for profit entities and some certain employee benefit plan. So closely held company we generally consider as a private company. Private company may elect simplify its accounting policy for VIE by instead of using other consolidation guidance, example voting interest model. The accounting policy election is available only if all the following conditions or criteria are met. So the reporting entity and the legal entity are under the common control, then you need to consolidate. Reporting entity and legal entity are not under common control of a public business entity. Okay. So I mean, there should not be any public entity who is controlling the reporting entity and the legal entity. The legal entity under the common control is not a public business entity, and the reporting entity does not directly or indirectly have a controlling financial interest in the legal entity. Okay. So first three is clear. I think the reporting entity and the legal entity are under common control. They should be like drive by the common management. And the reporting entity and legal entity are not under common control of public business entity, because like if they are under the public business entity or public company, so in that situation they cannot get the relaxation which is applicable to the private company. The legal entity under the common control is not a public business entity. Means the legal entity itself should not be a public business entity. Okay. And the reporting entity does not directly or indirectly have a controlling financial interest in the legal entity. So the reporting entity, because they should have direct or controlling financial interest in the legal entity. So I must disclose this again. Generally, the reporting entity should have directly or indirectly have a controlling financial interest in the legal entity. Otherwise, why they are going to consolidate? Entity not the reporting entity. Just a minute. Yeah, so if the reporting entity does not directly have a controlling financial interest in the legal entity, then they don't have election described. Okay, understood. Not financial interest in the. Just take an example. Like the fourth word. Okay, so if the means the reporting entity gives an asset on a lease. Okay, if this is the situation, then they are not much interested in their or they are not controlling the financial interest. Okay, so that we need to consider. Okay, so you can apply the like alternate accounting policy. Okay, if this four conditions are satisfied, so it is basically for the private companies only. Okay, and the most important is basically you should not have any financial interest. Okay, so parent company or parent private company should not have any financial interest in a mm, have a controlling financial interest in the legal entity. Okay, so what happened if I gave maybe the 100% asset on a lease, just 100% asset on lease. Okay, so in that situation, my expectation is basically the lease amount. Okay, I do not have any variable interest, like whatever may be the, I mean, interest is not depend on the profit. Okay, so what does it mean? I mean, I'm not, means it is not required to control the financial interest, to control financial interest. Okay, so I may not require to consolidate the legal entity in that situation. Okay, so this rule is applicable only for the private company. So a private company must disclose its accounting policy election and describe its involvement with the legal entity under the common control, including any risk or exposure. If the alternative accounting policy is elected, it must be retrospectively for all the period. So if we change the accounting policy, then you need to apply retrospectively. Okay. Okay. So that is basically the private company accounting alternative. Means they do not require to consolidate in this situation. They can just give the disclosure. Next, acquisition method. So acquisition is basically we are going to acquire entire company. Okay. So in a business combination accounted for an acquisition, the subsidiary may be acquired cash, stock, debt, securities, etc. Okay. So here two separate company. Okay. Then there is a like we are acquiring the investment stock. Stock means shares. Okay. And against that we are paying their shareholders a cash. Okay. And then we need to do the consolidate. So consolidation we can do if we acquire more than the 50%. So the investment is valued at the fair value of the consolidation given or the fair value of the consideration received, whichever is more clearly evident. So accounting for an acquisition on the date of acquisition. Okay. Okay. So first, when you invest in a subsidiary, so it is basically investment in a subsidiary account to the cash account, and the journal entry record the acquisition of the parent company stock. Okay. So investment in a subsidiary debit, I mean whatever the stock we issued and the epic. Okay. So that is basically the entry. Means we can acquire the company in two ways, either by cash or either by issuing a fresh equity to the shareholders of the fresh equity to the shareholders of the subsidiary. Okay, so if this is the situation, if I acquire it at cash, so cash investment account debit, to cash account credit, normal entry. Okay, but if I acquire the subsidiary by issuing a fresh equity, then again investment and the common stock at par value, and the additional paid in capital. This is basically the issue of shares. Okay, so Tag Inc. Announces that it has agreed to buy sub company on April 1, year 1 for a 1 million share of its common stock. Okay, the transaction closes on September 30, year 1. So market price of the stock 1st April year 1, it is $10 and 38.9 close $14. So we need to consider the share price on the date of acquisition. Okay, so the transaction close on 30th September. That means we need to acquire the company. We are acquiring the company on 30th September. So we need to consider the price as on 30th September, which is 14. So acquisition price is 1 million multiplied by 14. It is 14 million. So date of purchase, stock price goes down. So it will not affect much. Tag Inc. announces that it has agreed to buy a sub company on April 1, year 1 for 1 million share of its common stock, and the closes on 30th September. So again, you need to consider the price as on the date of acquisition. So acquisition price is 7 million. Then application of acquisition method. So acquisition method has two distinct accounting characteristics. 100% of the net asset acquired, regardless of the percentage acquired, are recorded at a fair value with any unallocated balance remaining, creating a goodwill. Okay, when the companies are consolidated, the subsidiaries' entire equity, including common stock, EPIC, and retained earning, is eliminated, not reported. Okay, so that I'll just explain. Okay. Parent company and subsidiary company. Okay. So non-current asset, current asset. Okay. Non-current asset, say for the 5 million, current asset is 2, so it is 7 million. Okay. Here equity. Okay. Non-current liability and the current liability. In current asset, there is a one more I'll write here, including investment in subsidiary. Okay, investment in subsidiary. Okay, which is basically 1 million. Okay, so in current liability, equity. Okay, so it is here 2 million, 2 million, and the 3 million is equity, and again it is a 7 million. Okay, in a subsidiary, equity, like here, non-current asset is 1, current asset is 1, or non-current asset, I'll 2, 1, current liability is 1, non-current liability is 1.5. Okay, so equity is 0.5. Or I need to bring it 1.5. So this we consider. These are the two financials. Okay, how we are going to consolidate this? Okay, if I assume all figures in a subsidiary is in how I can say fair value. Okay, so then there is no question of goodwill arises. Okay, if there is a number of means the fair value is something different from the reporting value. Okay, so then the question of goodwill arises. First, we see how we are going to consolidate. Okay. Okay, so in a consolidation in a parent company, okay, so it is the consolidated financial of the parent company. Okay, I need to add line by line item. Okay, so non-current asset 5 and 2.5, which is 7.5, no issue. Here the current asset 2, out of this 1 is basically the investment in subsidiary. So I'll just consider the 1 here. Okay, 1 and 1.5, it is 2.5. That is my consolidation. Okay, originally it should be 3.5. Okay, but I write 2.5 because I need to do the adjustment for the investment in subsidiary. That I will see how I am going to do it later on. Okay, so this 9 and the 10. Okay, now I need to consolidate the liability. So first current liability as it is 2 plus 1, it is 3. Non-current liabilities 2 plus 1.5. Okay, I need to maintain 3.5. Okay, here if you see 3 plus 1.5 should be 4.5, but if I add here then it would be more than 10, it could be the 11 because I have not consolidated the consolidate the one which I invested. Okay, so equity I need to maintain the parent company value. Okay, so equity is my parent company. Okay, my investment is 1, get offset against the value addition and the non-controlling interest which I need to maintain the 0.5. Okay, how I arrive at the 0.5? Say for equity, total equity I have a 1.5. Out of this, one is basically my investment. So I remove it and the balance 0.5 I need to recognize as a non-controlling interest, which is attributable to the other shareholders. Okay, and if I add together 6.5, 7 and 3, 10, this get tallied. Okay, again I tell you, subsidiaries net asset is basically total asset is 4, which I took from here, minus total liability excluding equity. Okay, which is basically 1.5 plus 1, it is 2.5. Okay, so net asset taken over is 1.5. Okay, from this 1.5, amount which I invested is basically the 1. Okay, so 0.5 is basically non-controlling interest, means the valuation pertains to the outsiders. Okay, not the parent company. Okay, so that 0.5%, 0.5 I need to bring here as a non-controlling interest. Okay, and my share means this one is basically out of this 1.5 I am going to recognize 0.5, but the one get offset against the investment in my asset. Okay, so here instead of consolidating 2 as it is, I've just add the 1. Okay, like 1.5 is the current asset with a subsidiary and 1 is a current asset with a parent company. So I just keep 2.5 number and the investment I need to offset against the share of the my equity in a subsidiary. Clear? Anyone has any doubt? Okay, so see, we take one more example. Okay, and here we need to consider the goodwill. Okay, parent. Just keep in mind, non-current asset, current asset, non-current equity, non-current liability, and current liability. I am not writing the name. Okay, so current asset is 2, non-current asset is 1. Okay, then a non-current liability is 1, current liability is 0.5. Okay, so 1.5 and the 1.5 is my equity. Okay, so 3, 3. Subsidiary 1.5. Okay, then 0.25, 0.75 and here 0.5. So 1.5 and 1.5. Okay. Again, this is equity, non-current liability, current liability, non-current asset, current asset. The same is here. Okay. If I assume the value of fair value of the asset is more than whatever the stated value, it is basically the 2. Okay, maybe the appreciation in the asset value, current asset or non-current asset. Okay, liability as it is. Okay, so how much net asset I am taken over here? Sorry, 1, not equity. So it is 1 I need to take over. Okay, against my equity. Okay, and in point 5, if I assume the point 4 is belongs to me, okay, and I mean in current asset there is a point 4 is my investment, okay, belongs to me, and the point 1 means the 20% belongs to subsidiary. Okay, so net asset value is 1 again the point 0.5 of the equity. Okay, so what is my goodwill? 0.5. Clear? Whatever may be the appreciation in a net asset, okay, that I need to consider as a goodwill amount. Okay, means if I assume my purchase consideration is as it is 0.5, whatever the equity I shown, that is my total purchase consideration. So it is because goodwill is 0.5. Okay, so consolidation now how it happened? 1.5 current asset, 1 current non-current 2.5 non-current asset, okay, 1 current asset, okay, and the 0.5 goodwill. So 2 plus 1 plus 0.5, so it is 3.5. I consider goodwill as well. Goodwill. Okay, whatever may be the appreciation in a value, that I need to consider as a goodwill. So 2 plus 1 plus 0.5, this is 3.5 is my goodwill. Okay, so 3.5 is my goodwill. In current asset, 0.4 is an investment that I need to keep it. I mean, right now I should be the silent. So 1 minus 0.5, it is 0.6, and the 0.5 which we need to consolidate, which is 1.1. Sorry, 0.9. Okay, so that is my current asset. So total is 3.5 plus 0.9, 4.4. Okay. Then the liability 0.5 plus 0.25, it is 0.75. Okay. Then non-current liability 1.75. Okay. Now non-controlling interest. Okay. So net asset value taken over is 1. Okay. So non-controlling interest is basically the 0.2, 80% of this amount. Okay, because 20% of this amount. Okay, 80% is basically belongs to the how I can say 80% is belongs to the parent company. So I need to recognize here 0.2. Okay, non-controlling interest. Okay, so 2.5, 2.7. Non-controlling interest. 4.2, and the equity should be 1.5. Oh, just a minute. Die 4 4.2.2 कहाँ गया? 0.6 and 5, so it should be 1.1. Sorry, not point 0.4. 0.4 is an investment, so 1 minus 0.4, 0.6 plus 0.5, so it should be 1.1. So if it is 1.41, so it is 4.6. And now if I add here 1.7 plus 2.4, 2.5, 2.7, it is 4.2, sorry, 4.2. So there is a 0.4 difference, just one minute. हो गया 1.1 2 plus 3.3. The investment value should be more. Okay. Understood. This investment should not be 0.4. It is basically the 0.5 goodwill. Okay, so one is net, so it should be the 0.8 actually. Okay, say I tell you something. Because the net asset value is 1, so goodwill when we are considering when we are acquiring at a higher value. Okay, so one in subsidiary my investment is 0.5. Okay, is the capital, but along with the goodwill it is 1. Okay, so 80% should be my investment, so which should be the 0.8. Okay, so I need to consolidate here 0.2 only. So 0.2 plus current asset 0.75, so it is 0.95, and this way we need to calculate. So it is 5 plus 5 0, and now sorry, 5 4 and 3, 4.45. Okay, and here also 0.75 or 2.5, 2.5 plus 2. Okay, we need to do again same number 1.5, 1.5, 1, 0.5, 2, 0.2, 0.8. Okay, this is investment. Point 5, 0.75 and 0.25, 1.5. Okay, parent and subsidiary. $1.5. And then consolidate. Okay. See again, if you see, we consider the goodwill is 0.5, 0.5, because appreciation in the value of the asset. Okay. And if I add equity in subsidiary, okay, which is also 0.5. So total value of the subsidiary is 1, which is shared by 0.8 through investment by the parent company, and the 0.2, it is basically the non-controlling interest. Okay, if I'm getting in goodwill, so I need to pay for it. So it is basically the 0.8 belongs to that. Okay, it cannot be the same as the value of the equity like this. Okay, now we need to do the consolidation. Okay, so goodwill we already, I mean, how to calculate the 1.5, and there is a value of appreciation. So 0.5 is a goodwill. Here the 0.5 is a goodwill. So, sorry, yeah. So 1.5 plus 2, 3.5 is my fixed asset. Current asset is 0.2. Here I bifurcated. Okay. So 0.2 plus 0.5. So it is 0.7. Okay. This is my current asset. Current liability 0.75. Okay. And non-current liability 1.75. Okay. Now the equity I need to maintain the parent company 1.5, and the 20% which we consider, it is a non-controlling interest, so it is 0.02. Okay. Now you can see either 4.2, 0.7, 1.7, 2.5, 2.7, and plus 1.5. So again it is 4.2. Okay. So, like whatever the goodwill amount, it should represent in a investment in a like the parent company. So that is the mistake actually. I just consider the 80% of this amount. It should not be the case. It is the total value purchase consideration. Okay. If I consider the goodwill of 0.5, that means we paid additional amount of 0.5. Okay. Total equity given in the subsidiary is 1. So we consider the market value of the subsidiary is 1. Accordingly, for acquiring an 80% amount, I need to make an investment of 0.8. Okay. So this way we need to do it. Any doubt here? Okay, we may have one example here, so we can I can explain on it. Okay, so common stock, epic, and retained earning of a subsidiary are eliminated. I means if you see, we are not giving any addition of the subsidiary. Investment in subsidiary eliminated. That is also not get carry forward. I mean this amount is not get carry forward here. Non-controlling interest is created, so that I created here. Balance sheet of subsidiary adjusted to the fair value. As I said, 0.05 goodwill I have recognized. So balance sheet of the subsidiary adjusted at a fair value. Identifiable intangible asset of the subsidiary are recorded at their fair value. Means any asset we need to record at their fair value. And the goodwill or gain is required. So if I pay more amount, then we need to recognize the goodwill. Okay. So which is considered here like this. Okay. So this way we need to do. So now consolidated work paper eliminating journal entry. Okay. So this basically what we are doing, we are reducing the value of the means how we are means what journal entry we need to pass in a subsidiary to close and transfer it to parent company. Okay. So common stock subsidiary we are eliminating. Epic subsidiary we are eliminating, retained earning subsidiary we are eliminating. So that's why we need to debit. Then investment in subsidiary we need to credit. Investment in subsidiary means this amount we are eliminating. So that's why we need to credit. Non-controlling interest we need to credit. So that we are going to create additional liability. Okay. So it is basically if I add everything together. Okay. So then what would be the situation? Okay. And the balance sheet as adjustment to the fair value. Identifiable intangible adjusted to fair value, and the difference is goodwill. Okay. So here if I assume 0.5 amount is added in my asset, so that I need to adjust it in the asset value, and that we need to recognize as a goodwill. So this way we are doing it. Okay. So if I want to make an entry here, so it is basically the equity in subsidiary debit. Okay, this is basically this 0.5. Okay, all coming together. Okay, then asset value we are increase. So that is also the debit 0.5. Okay, investment in subsidiary credit, which is 0.8. We created the non-controlling interest, so it is credit 0.2. Yeah, so this will give the value journal entry. Means if I add all together and then I do the adjustment of this, okay, so then I will get the I will get the consolidated financial statement. Means it is line by line item adding, like 1.5 plus 0.5 minus 0.5. Okay, so it is coming around 1.5. 1 0.75, it is as it is. Asset basically 2 plus 1, 3 and plus 5. So that's why it is 3.5. That's why we need to do it. So that would be my adjustment journal entry. Means I added the line by line item and then whatever may be the adjustment journal entry that I reduce as it, which will give me the consolidated financial statement. Yeah. So what we need to debit here and what we need to credit here. Okay. So again, this is basically the flow chart. Like common stock, we need to debit, Epic subsidiary retain earning with debit, and then investment in subsidiary, we need to debit non-controlling, credit, and non-controlling interest again credit. So whatever may be the difference, that is fair value adjustment. So identifiable intangible asset we need to add, and whatever may be the then I mean if it is a we pay the more consideration, then the goodwill arises, and if we pay the less consideration, then the gain arises. Okay. Okay. So see, first we need to bring it to book value of the asset to the fair value of the asset. Okay. And that we need to recognize as a gain. It is in the books of subsidiary. And then the fair value of the subsidiary net asset and the acquisition price. Okay. That difference is basically the goodwill. Asset liability minus and the liability car formula. The following formula is to book value of the asset acquired minus net book value, asset minus liability equals to car. Okay, acquisition date calculation that we see. So, I mean, whenever we are doing a consolidation, okay, subsidiary book value and subsidiary fair value, asset fair value. Okay, that adjustment we need to do in the books of subsidiary, and it is basically the gain. It is not goodwill. Okay, then subsidiary fair value and the purchase price paid. If the purchase price is more, then it is basically the goodwill. So, when the subsidiary financial statement are provided for a subsequent period, it is necessary to reverse the activity income and dividend in the subsidiary's retained earning in order to squeeze back into the book value. So, asset minus liability, acquisition date. Okay. On acquisition date, book value and the fair value is computed as the acquisition. So, beginning retained earning, add income, subtract dividend, which is give me the ending retained earning on the date of acquisition. Okay. Then common stock, Epic and retained earning that we need to calculate from here, minus investment in subsidiary, minus investment in controlling non-controlling interest. Okay. So which will give the balance sheet adjusted to the fair value, identifiable and the goodwill. Okay. This is basically the identifiable balance sheet adjusted fair value and the identifiable intangible asset at fair value and the goodwill that we need to give. Okay, so it is more or less same. You need to first adjust the fair value of the asset, okay, and you need to then evaluate whether you paid the higher amount or not. If you paid the higher amount, then you need to recognize the goodwill. Investment in subsidiary, okay, original carrying amount. So original carrying amount of investment in subsidiary account on the parent book is original cost measured by the fair value of the consolidation given and the business combination in acquisition related to, so direct out of pocket cost and indirect and the stock registration initial, these are basically the expenses. Okay. Okay, so basically it means whatever the actual amount paid plus whatever the expenses related to the amount paid or the issue of shares, that we need to consider as a investment in subsidiary. Example. Okay. On January 1, year 1, big company exchanged 10,000 shares of 10 par value. Company stock with a fair value of 4 lakh 15,000 for 100% of the outstanding stock of sub big company, paid 35,000 legal fees. So at the date of acquisition, the fair value and the book value of the company's net asset total 300,000. Registration fees were 20,000. Okay. So how much amount we paid for acquisition, which is 415,000. Fees, it is 4,15,000. Okay, that is my investment. Okay, 4,15,000. And on the date of acquisition, in addition, big company paid legal fees. That is my legal expenses. 35,000. Okay. So here cash account credit, because this amount we paid with a cash. 35,000. For on in 4,15,000, what we acquired actually, net asset 300,000 minus 20,000. Total 300,000. 35,000 legal fees at the date of acquisition. Registration fees was 20,000. So cash 35,000 plus 20,000 is my registration fees. Okay, this is my credit. So it is 55,000. Okay, common stock 10,000 at par value, which is 10,000 multiplied by 10. So it is 100,000. Okay, and the remaining means whatever may be the difference, that is my additional paid in capital. So it is 4,50,000 minus 1 lakh, 3,50,000 minus 55,000. So it is 2,95,000. Okay, that would be my journal entry. Okay, so here if you see registration fees I paid. Okay, so that is basically the why it is adjusted in an additional paid in capital, and we have not shown the expenses, because this we consider as a the element. I mean, so we need to reduce the means whatever the amount we paid or capitalized, that we need to reduce. Okay, because this is the expenses for the issue of the shares. Okay, so that's why we need to adjust in a additional paid in capital. Okay, and the 4,15,000 is a purchase consideration, and for that legal expenses we paid the 35,000. So that is an expenses in the books of parent company. Okay, and what they issue to acquire this to get the company, or how they are going to settle it, they issue the common stock of 100,000, additional paid in capital of 295,000, and the cash account credit. So 295,000 should be 3,15,000. Okay, but 20,000 registration fees we need to adjust in a additional paid in capital. Okay, so that we need to consider, because it is the expenses related to the issue of the shares. Okay, now in the books of subsidiary. Okay, this get eliminated or not subsidiary, consolidation. This 300 in the subsidiary get eliminated. Investment in subsidiary, that also get eliminated, and the goodwill we need to recognize 115,000 balance. I means whatever the excess we paid. Net asset is fair value, it is given 300,000. Against we pay the 415, so goodwill is 1,15,000. Means for the acquiring the net asset at fair value 300,000, we paid 415,000. So 1,15,000 is my goodwill, which is given here. Goodwill. So again, like in book value of the subsidiary, fair value of the subsidiary, and the acquisition price. Okay, so difference in this that we need to adjust in the balance sheet of subsidiary. Subsidiary. But the fair value and the acquisition price that we need to recognize as a goodwill. Okay, means whatever may be the difference, that is basically the part of retained earning or the equity. Okay, so that you need to adjust in a balance sheet of the subsidiary. Okay, so say for means I'll just giving an example. Book value is 100,000. Fair value is asset 120,000. Okay, and the purchase price is 150,000. 150,000. So here 30,000 I am going to recognize as a goodwill. Difference between this two. Okay, and the difference in this two that goes to retained earning of subsidiary, which is subsequently nullified while consolidation. Okay, so this difference goes to retained earning of the subsidiary. Means whatever may be the retained earning subsidiary, that balance is when it is the balance sheet is prepared as per the book value and a standalone, that get increased and which we need to reverse it. Clear? Any doubt here? Okay. So now the contingent consideration. Contingent consideration means the subsequent, there may be a provision for the subsequent consideration on the basis of success of the company. So contingent consideration is an obligation of the parent company to transfer additional asset or equity interest to the former shareholder of the subsidiary if specified conditions are met. So contingent consideration is recorded by the parent company on the acquisition date by adding an estimate of the probable settlement cost to the investment in subsidiary and creating the liability expected value of the consideration uh, uh, contingent consideration. So whenever means the value of investment, say for means original value is 4,15,000 and the consideration additional म्हणजे contingent consideration might be 42,500. Okay, so we need to record this on this number, which is 457,500. Okay, which is 457,500, and we need to recognize additional liability for 42,500. So it is basically the estimated liability for contingent consideration 42,500. Means everything is same. We just need to estimate the additional amount need to pay. Okay, and that we need to add in the value of investment and the contingent liability, estimated liability for contingent consideration. This way we need to do. So again, in the previous example, investment in subsidiary 457,500, which is means 42,500 is added. The basic amount is 415,000. If you see here, 415,000. Okay. If sub average income during first to 4 year exceed 50,000 annually on the acquisition date, okay, big believes that there is a 50% probability that sub will achieve the earning target over the 4-year end period. Okay, so in that situation, in addition stock, you should be agreed to pay an additional 85,000. Okay, so 50% of 85,000 we need to pay. Okay, because we are expecting the 50% chances. So, and we supposed to pay 85,000. So 50% of 85,000 we need to we estimate that there may be a liability. Okay, so that we can create by increasing the value of investment in subsidiary and creating a separate liability for the contingent consideration. And again, then the number change is basically investment in subsidiary and the goodwill amount. The rest all are the same. Okay, because see, whatever the additional amount paying, that will affect to the goodwill. Okay, because the goodwill formula for goodwill is purchase consideration minus fair value of the asset. Then parent company accounting for the investment in subsidiary. Okay, parent company. Okay, so like means that we are talking means in a standalone financial, how they are going to account for. So cost method, under the cost method, the investment in subsidiary account does not change after the acquisition date. No adjustment are made to the account for the parent share of subsidiary income. Dividend received from the subsidiary are recorded by the parent as a dividend income. So generally, cost method adopt when the investment is less than 20%. Investment in subsidiary less than 20%. So we kept cost investment value as it is. It will not change. As it is. Okay, it will not change. Okay, and the dividend we need to, whatever the dividend received, we are showing as the income. Clear? This is basically the cost method. In equity method, which we generally adopt when the investment in subsidiary is more than 20%. But less than 50%. Okay, so in that situation, we follow the equity method. So in P&L, we transfer the share of profit yearly basis. Like in cost method, we are showing dividend as an income. In P&L, we show share of profit as a income every year. Okay, in investment, we recognize at cost. Okay, then we add share of profit and reduce dividend received. This is basically the difference. Okay, and whatever may be the closing value, that is the investment closing value. Okay, so this is basically the cost method and the equity method. Okay, in cost method, it is a very straightforward policy. We need to recognize the investment at a cost, means whatever the pay originally amount we pay, and there is no further adjustment. Whenever we receive the dividend, we are showing this as a income. In equity method, we are showing means it is just like an opening investment value, whatever the acquired means the amount paid at the time of amount invested in a other company. Okay, then whatever may be the share of profit for a particular year that we are going to add in an investment, whatever may be the dividend received, that we reduce from the investment, and the closing balance is my closing investment value. So in equity method, on year to year basis, investment value get changed. Okay, and the profit which we need to show in an income statement of a parent company, that is basically the share of profit of a subsidiary company. It is not the dividend. Dividend we consider as a return of capital, and that we need to reduce from the investment value. So equity method that is used by the parent company to account for the investment in subsidiary is same method used by the investor that exercises significant influence over the investee. So under the equity method, the investment in subsidiary increases by the parent company's share of the subsidiary's net income with the corresponding credit to the income statement. Okay, so share of the profit we need to show as a income, and equity in subsidiary, okay, and the dividend received from the subsidiary decrease the investment in subsidiary. That way we need to do. So here share of the profit we need to add, and the second effect goes to the P&L, and dividend received we need to reduce, and the second effect goes to the cash because we receive the cash. The advantage of the equity method is that changes in subsidiary equity are reflected in the parent investment in subsidiary account, which simplifies the elimination of the investment in subsidiary when consolidated financial statements are prepared. So that is basically the benefit of the equity method. Okay, so we can see one example. On January 1, year 1, Gaiety Corporation acquired 100% of Olinto Corporation. Gaiety Corp issued 100,000 shares of 10 per common stock with a market price of 15 on the date of acquisition was announced, and 25 on the date of acquisition was completed. Okay, so we need to consider the 25. So on the date of completion, whatever the price is. Okay, so what is my purchase consideration here? Okay, it is how much shares? 100,000 shares multiplied by 25. So it is 25 lakh. Okay. December reported net income of 350,000 and paid cash dividend of 150,000. Okay. So original amount is 250,000. As I acquired the 100%, so 100% profit is belongs to parent company. Profit in subsidiary. Okay. That I need to, how much is the profit? 350,000. That I need to add, and then I need to reduce the dividend. Okay, that is basically how much is dividend paid? 150,000. So what is my closing value of the investment? This is my add, this is my minus. Okay, so it is 2,70,000 or 27 lakh, sorry. Okay, so that is my value of the subsidiary. The second effect of 350,000 means investment account debit to P&L account credit, or profit from subsidiary account credit. So that is P&L item. And here the second effect, cash account debit, investment account credit and the cash account debit. Okay, that you need to come. And the 27 lakh is basically the closing value of the investment. Any doubt here? Equity method. In cost method, we need to record the investment at a cost, and then there is no adjustment. Okay, whatever the dividend received, that you need to show as a income. In equity method, we need to keep on adjusting the value of the investment, and you need to consider the share of profit in a subsidiary and the dividend we received. Non-controlling interest. So as we already, I already explained, non-controlling interest is basically we are not able to acquire the 100% shares. So there are certain stake which belongs to the outsider. That is basically the non-controlling interest. Okay. So how we calculate? We need to calculate the fair value of the subsidiary. Okay. So book value may be 100,000. Okay. But the fair value is 120,000. And if I consider the 20% stake belong to outsiders, okay, so value of the non-controlling interest, we need to calculate with reference to the fair value, not with the book value. So 20% of 120,000, which is 24,000. So whenever we are preparing the financials, okay, so we need to credit in a capital with a 24,000, and the remaining amount means because I need to pay for the 80%. Okay, so automatically my investment recorded at 120 minus 24. So how much? 96,000. This is basically investment in parent company. In parent company. Okay, because I pay, I mean, we should pay to the buyer, seller, okay, at a fair value. So I paid with a cash of 96,000. The outsiders value get automatically increased due to the fair value increase. There is no cash transaction. Okay, and while consolidation, I want to maintain the outsider stake at a 24,000 instead of 20,000. Here it should be the 20 and 80,000 as per book value. Okay, but this amount I purchase at a 96,000. It is like this. Okay, and there is no question of goodwill because fair value difference in fair value and book value is adjusted in a standalone financial of the subsidiary. We are not consider the goodwill with reference to the book value. We consider the goodwill amount purchase consideration minus fair value. Okay, any doubt till now? So we need to calculate the non-controlling interest for the consolidation purpose with reference to the fair value of the subsidiary. Okay. Non-controlling interest after the acquisition date. So beginning the non-controlling interest plus non-controlling share of the subsidiary income and non-controlling share of the subsidiary dividend. That's why we calculate. Because see, once we make a consolidated financials, then on year-on basis, year-on-year basis, we are not going to calculate the fair value. Okay, so then it is basically the means whatever the book value that we need to carry forward. Okay, so that's why adjustment in non-controlling interest pertains to their share of profit and whatever the dividend we paid. Okay, non-controlling interest. Okay, so share of profit need to add in the old balance of non-controlling interest, and that we need to whatever the dividend we paid, that we need to reduce it. So consolidated income statement will include 100% of the subsidiary's revenue and expenses after the date of acquisition. The consolidated income statement should show net income attributable to non-controlling interest separately from the income attributable to the parent company, because we need to give an adjustment. When I consolidate all the income and expenses, okay, so that means all the sale and purchases get added. Okay, so subsidiaries income, subsidiaries expenses, and the subsidiaries net income, then non-controlling interest that we need to show separately. Net income attributable to non-controlling interest that we need to show separately. Like in a partnership, if you see the partnership account, whatever may be the profit and loss that we need to bifurcate in the partners, the same we need to do. So it is basically income expenses. Okay, so here income item, expenses items, and whatever may be the net income that need to derived in two way, non-controlling share and income of the parent company, that we need to add. And while transferring this income, non-controlling share, we need to add in a original NCL in a equity section. And this income pertains to the parent company that we add in a retained earning. Now we need to see. Means how we need to calculate eliminating the journal entry. Okay, calculate the non-controlling interest, that also we need to see. Guarantee company acquires 60% of the Foxing for 69 lakh. The fair value of the Foxy. Okay, if I acquire 60%, okay, at 69 lakh, okay, so how the fair value should be of the all asset? 69 divided by 0.6, okay, which is roughly 115. Okay, that is 115 lakh. Okay, this number I consider in a lakh. This way we need to calculate. Non-controlling interest, okay, which is 40%. So 150, 40% is 46 lakh. Yeah, okay. Fair value of the proxy includes goodwill is 115. So fair value at the identifiable net asset. Okay, so 115 is my purchase consideration. Value of identifiable net asset. Fair value of identifiable net asset, which is given 100,000. 100,000. Okay. 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 This is fair value. Okay. And the book value given is 80,000. 80,000. So this is irrelevant actually. 80. Okay. 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 So this number is irrelevant. We need to calculate goodwill with respect to this two, fair value and the purchase consideration paid. So it is 15 million. This is my goodwill. Okay. So value of the asset appreciation. So that is that 20,000 we need to consider as the asset value appreciation, which 2 million I can say, okay, which has the corresponding effect of retained earning of subsidiary. Okay, so that you need to consider. Goodwill you need to calculate with reference to the fair value, and whatever may be the increase in book value to fair value of identifiable asset, that we need to consider as a retained earning of the subsidiary. Let's see the entry. So asset get or the equity get down 80 million, and the investment in subsidiary 69, and non-controlling interest 46. So balance sheet adjustment for the fair value, which is basically the 2 million. Okay, and the goodwill is 1.5 million. It is like this. Okay, so this way we need to do. Okay, so that get automatically adjusted. Any doubt here? Balance sheet adjustment to fair value, identifiable in the adjustment to fair value in the goodwill. Okay, fair value of the subsidiary. Okay, so that is basically the fair value of the subsidiary. Under the fair value is equal to the acquisition cost that we already consider, fair value of the subsidiary. Okay, so that is basically acquisition cost plus fair value of NCL. NCL. Okay, if my acquisition cost is for 80% stake, so whatever may be the acquisition cost, okay, divide by 0.8 or the 80%. Okay, that is basically the fair value. Okay. So on the acquisition date, the fair value of subsidiary must be compared with the respective asset and liability of the subsidiary. Any difference between the fair value of the subsidiary and book value acquired will require an adjustment in the following three areas. Balance sheet, adjustment of the subsidiary asset from book value to fair value. Identifiable intangible asset related to the acquisition of subsidiary are recorded at a fair value, and goodwill is recognized for any excess of fair value of the subsidiary over the fair value of the subsidiary net asset. So if the fair value of subsidiary is less than the fair value of the subsidiary's net asset, gain is recognized. Okay, so whatever may be the increase in book value to subsidiary value, book value to fair value, that we need to consider as a increase in the equity. Any contract asset or liability on the book of the subsidiary entity that are acquired through a business combination should be recorded on the book of the acquirer using the standard revenue recognition principle. Okay, so like because of consolidation or the business combination, if there is acquired through means any asset or liability we need to acquired, that we need to recognize as per the revenue recognition principle. Means if it is when we close the deal, at that time we need to record it. Acquisition of the goodwill, so it is basically balance sheet at the adjusted fair value and identifiable intangible asset to the fair value. Okay, so whatever may be the amount paid, that we need to calculate the difference between this. Okay, so when acquiring a subsidiary with fair value, acquisition price plus fair value of the NCI that is greater than the fair value of the underlying asset acquired, the following step we need to follow. So first we need to adjust the balance sheet item, and then we allocate the intangible asset to the fair value. This way we need to do. So these are basically the identifiable intangible asset: agreement and contract, right, permit, patent and copyright, trademarks and trade name, computer software and license, technical drawing and manual, customer list, unpatented technology in process research and development, and competes. Okay. Okay. So in process research and development, generally we need to recognize as a expenses. Okay. So recognize as an intangible asset separately from goodwill at the acquisition date. Do not immediately write off. In process research and development, meet the definition of an asset. Okay. If I am doing any expenses for research and development on ongoing business, then we need to expense out. Okay, but if I acquired by cash, okay, then we need to consider this as an asset, and which we need to recognize separately than goodwill. Okay, clear. See what happened. Generally, I mean, if we know the research and development expenses, we are expense out till the technical feasibility arises. Okay, but if we are acquiring some research and development through a cash, okay, so then you can recognize this as an asset. Okay, and whatever may be the further expenses that we need to revenue, Okay, but when the technical feasibility is established, then you can capitalize it. Okay, so this identifiable intangible asset are separated in two categories: finite life and infinite life. So if there is a finite life, then we need to amortize over the remaining life, and the infinite life that we do not require to amortize, it is subject to impairment test. So this is correct. Infinite life means life extend beyond the foreseeable future. Finite means useful life is limited. Say for we have a restriction through contract, or we have a restriction through government regulation. Okay. So if this is the case, then it is a finite life. Amortization none over the useful economic life, and the impairment test, one step test and the two-step test. So that we will discuss later on, impairment test. Goodwill. How you can calculate the goodwill? You need to calculate purchase consideration minus fair value of the asset acquired. That is my goodwill value. The goodwill is generally not amortized, and we need to, I mean, it is not amortized, we need to test for an impairment. So acquisition goodwill is subject to impairment testing. In the period it is determined to be impaired, it is written down and charged as an expenses against the income on income statement. Okay, again, private company accounting alternative. So as under the US GAAP, a private company may elect an accounting policy under which it would not be separately recognize the following intangible asset when accounting for business combination. So intangible asset that would otherwise arise from non-compete agreement or customer related intangible assets that cannot be separately sold or licensed, such as customer list, order backlog and customer contract. So instead, the value of this asset would be included in goodwill. Okay. And the accounting alternative also applies where private company is required to recognize the fair value of intangible asset as a result of. Okay. So what happened? I mean, there are certain intangible assets which cannot be separately sold. So that you can consider as a part of goodwill. Okay. Only if it also elect the private company goodwill accounting alternative. However, the private company can elect the goodwill accounting alternative without electing the alternative for a business combination. Once selected, a private company should apply this accounting alternative prospectively to all business combination. Okay. So, I mean, they can, instead of recognizing separately the cost for identifiable intangible asset, we can consider treat this as a goodwill. That is basically means when the two conditions are satisfied. One is intangible asset that would otherwise arise from the non-compete agreement. Okay, means if it is non-compete agreement, then the valuation we need to calculate. But if it is not non-compete agreement, then you can consolidate. You can consider as a part of the goodwill. Plus customer related intangible asset that cannot be separately sold or licensed, such as customer list, order backlog and the customer contract. So that is also you can consolidate as a part of goodwill. So how we can calculate the goodwill? TAG purchased 60% of the Garrity company equity at 75 million in cash. The fair value of the Garrity's is 125 million. Okay. So means 60% we purchase 75 million. So what is the fair value of the subsidiary? Is 75 divided by 0.60, which is 125 million. Okay. The fair value of net identifiable asset is 60 million and the carrying amount of the GAT is 50 million. Okay. So fair value is 60 million and the book value or the carrying value is 50 million. Okay, so we need to compare the goodwill 125 and the 60, means the fair value as well as the fair value of the subsidiary. So difference is 125 minus 60 is my goodwill, which is 65 million. Okay, and the 40% of 120 means 125 minus 75, or the 40% of 125 is my NCL, non-controlling interest, NCI, sorry. Okay, so what is this 50 million? This is my non-controlling. How I calculated? The fair value of the subsidiary is 125 million, and 60% valuation is 75 million. Okay, which is with the guarantee. So difference is 50 million. This way I need to calculate. So again, entry is basically goodwill account 65 million debit, balance sheet adjustment 10 million, book value 50 million that we need to reduce, and the credit basically the 50 million NCL, and the investment in subsidiary is 75 million. You can see here all the equity portion of subsidiary is debit, investment in subsidiary is credit, we are reducing, non-controlling interest we are creating 50 million, balance sheet adjustment to fair value is 10 million. Okay, that is basically the book value to book value to fair value, and the goodwill is 65 million. Book value to fair value also we need to record. Acquisition with gain. Okay, like if I purchase, like fair value is 50 million of the subsidiary and purchase value is 60 million. What does it mean? I am giving a higher price. In that situation, the 10 million is goodwill. Okay, but instead of 60, if it is 40, then what happened? It is minus 10. That we need to treat as a gain on acquisition. Okay, so gain on acquisition. So that we need to calculate. Like Garrity company purchased 100% shares at 1 million. The net book value is 800,000 and where fair value of 100% share is 1.2 million. So in that situation, we need to create a goodwill. Fair value, 120 is the fair value. We are paying a less amount. So 200,000 is my gain. Okay, so it is basically, there is no goodwill. Balance sheet adjustment 400,000. This is basically increase from the book value to fair value. Okay, book value is 800,000. Okay, and the 200,000 is gain, and the 1 million is in investment in subsidiary. Okay. So this 800,000 is basically whatever may be the capital that representing net book value. That is basically the capital portion. Capital, additional paid in capital and return earning, that is basically the representing here. Okay. So this way we need to close the entry. Okay. So like you can see common stock, epic and return earning is 800,000, which we saw here, this 800,000. One minute. So this gain we need to recognize in a P&L account. Okay, there is no adjustment in the financials. We need to separately recognize in a P&L account. That we can recognize under other income. Okay, so whatever may be the gain on acquisition, that we need to recognize in P&L, consolidated P&L, under the head of other income. Other income. Okay, so we can take a 15-minute break here and we start at 10 o'clock. So we will continue till 11:30. Okay? Okay, sir. Yeah. Hello. Okay. Am I audible?
Yes, sir.
Just a minute. Okay. Now we need to see measurement period adjustment. So the value assigned to the asset and liability of subsidiary are not always known with the certainty on the acquisition date. Okay, so I assume uh, we applied the estimated rate, but there may be a certain adjustment required after subsequent to the takeover. So when this is the case, the value recorded on the acquisition dated are provisional and may be adjusted during the measurement period. So provisional fair value are used in the consolidated financial statement that are prepared before the end of the measurement period. So see what happened. Acquisition on 30th September. Okay. And consolidation on 31st December means on year end. Okay, so that you need to consider. The measurement period cannot exceed 1 year from the date of acquisition. That cannot be exceeded. See, because once you publish a first financials, then you cannot make an adjustment. Okay, and with improved information is available, or it become obvious that no better information will become available. Either you have a proper information, or there is no further information. So during the measurement period, the following adjustment can be made. The subsidiaries asset and liability may be adjusted to better reflect their value on the acquisition date, and new subsidiary assets and liability that exercise on the acquisition date may be recognized. Okay, so what happened? Like we do the acquisition on 31st September 2025. On that date, some POs are issued. Okay, but we have not received the asset. Okay, that received after the acquisition. Acquisition. So this asset also we need to add. So measurement period adjustments are offset against the goodwill, and adjustment to depreciation and amortization reported in the period of adjustment are determined. So no reinstatement required. So changes in the value caused by event after the acquisition date are not included in the measurement period adjustment. Means see what happened. The existing asset which we acquire on 30th September because of subsequent event, like there may be a certain fire or something like that, the value get deteriorated. Okay, that we are not going to adjust it because the event happened subsequently after the acquisition date. But there may be a certain asset existed as on the balance sheet date, but we are not able to determine the fair value with a proper accuracy, that you can adjust it. Okay, and whatever may be the adjustment in fair value of the asset.
Sir,
Yes.
your screen is not visible.
Okay, okay, just a minute. Sorry. Yeah, now.
Yes, sir.
Yeah, okay. Okay. So I'll just briefly revise again. So acquisition is on 30th September, and the consolidation we did on 31st December, first consolidation or the reporting, first reporting date after the adjustment. Okay. So after the acquisition date, we may have some clue where we need to make an adjustment in the fair value of the asset existed on the balance sheet, or the existed on the acquisition date. Sorry. Okay, so that we need to do in a measurement period. Okay, first thing, measurement period cannot be more than 12 months. Why? If we issue the first consolidated financials, then you can make an adjustment for the measurement. Okay, second issue, if any means the value get down because of subsequent event after the acquiring date, okay, so that adjustment also you should not take into consideration. Okay, only those adjustment you need to take into consideration where you do not have a proper information and now you have a precise information. Okay, and because of that reason, whatever may be the valuation in fair value of the asset increase or decrease, that you can adjust. Okay, when we adjust the fair value of the asset, okay, it impact to goodwill. See, what is goodwill? Purchase consideration and the fair value of the asset, difference in fair value of the asset. Okay, so purchase consideration is fixed. It is fixed. There is no change in purchase consideration. Okay, but the fair value of the asset get changed. So because of that reason, because the purchase consideration, that is my goodwill, so goodwill also get changed. So whenever we give an effect to the fair value, the corresponding effect goes to the goodwill. Okay, because the purchase consideration is not changed, the fair value of the asset get changed, and because of that reason, goodwill also get changed. Goodwill is basically purchase consideration minus fair value of the asset. Okay. So we can see the example. Pathways Corp acquired 100% of Sidewalks Inc. on July 1, year 1 for 500,000. Provisional fair value were determined for Sidewalks asset and liabilities on the acquisition date, and the final acquisition date fair value were estimated on December 31st, year 1. So book value it is given, the provisional fair value it is given, okay, and the final fair value is given. So here if you see, there is an increase decrease in property, plant and equipment, in process R&D, and the in both this only. Okay, so calculate the goodwill recognized on July 1, year 1, okay, based on the provisional fair value, and calculate the adjustment of goodwill necessary to reflect the fair value. Okay, so goodwill we need to calculate on the basis of fair value. So how we are going to calculate? First, what is my purchase consideration? It is 500,000. Okay, fair value of net asset acquired. Okay, if this is the situation, then 100 current asset, long term investment, property, plant and equipment, and in process R&D and the liability. So it is basically 250, 350, 450 plus 25. So it is 475. No, 100, 200, 450, 475. Yeah, 475 and minus 50. So it is 425. So goodwill is basically I paid additional 75,000. So that is my goodwill. Okay, and this is on the date of acquisition. Acquisition. On the date of reporting period, same amount 500,000 purchase consideration. Here net asset acquired is changed. Means if you see here, like 125, 125, and then 200, 460, and it is 410. Okay, so goodwill amount is 90,000. Okay, so this is basically so therefore the goodwill will increase by 15,000 because the fair value of the asset get changed. Fair value of the, if you see here, the major variation is basically the 100 to 75. This is 25 deletion or reduction, and the 10 is basically here increase. So net effect is 15 reduction in the fair value, which will increase the goodwill value. So this way we need to calculate. Means the formula is same. Purchase consideration minus fair value of the asset acquired. Okay, that is the formula for the goodwill. Whatever may be the changes in the fair value of the asset acquired, that will directly affect to the goodwill amount. Okay, but that adjustment we can do only when like before publishing the first consolidated financial statement. That you need to keep in mind. So that's why the condition is given, the measurement period is less than 12 months. Okay, even if you acquire on 1st January 2024 and your reporting period is first reporting period is 31st December 2024, that is also the 12-month period. Okay. Any doubt till now? I just quickly summarize. Means the basic issue is basically first is book value to fair value. Book value to fair value. Book value to fair value. Okay. So this will affect retained earning. Okay. We are not considered the book value for the calculation of the goodwill. Then purchase consideration to fair value. Okay. So that we consider for the calculation of the goodwill. Goodwill. Second point, like if I acquired 75% for 75 million. Okay. So what is the fair value of the subsidiary? Subsidiary is basically 75 million divided by 0.75. That means 100 million. Okay. If 100 million is, it is fair value of the subsidiary, not the fair value of the asset taken over. That is something different. Okay. Fair value of the subsidiary is always including the goodwill amount. Okay. So non-controlling interest here, 100,000 is fair value of the subsidiary, 100 million is fair value of the subsidiary. Okay. And the 75 million stake is associated with the parent company. So non-controlling interest is 25 million. Okay. So in your consolidated financial statement, you need to create the liability for 25 million. Okay. Good. Fair value of the asset acquired, net asset acquired, okay, is 80 million. My purchase 80 million. So my fair value of the subsidiary is 100 million. Fair value of the asset acquired is 80 million. So what is my goodwill? 20 million. We need to calculate the goodwill for entire subsidiary. Okay. Not for the parent company stake. Okay. So it is not like this. The fair value of the asset is 80, fair value of the asset is 80 million. So I need to consider the 60 million and the 75 million and the 15 million is goodwill. It should not be pertains to share of the parent company. It is pertains to entire subsidiary. So goodwill amount is 20 million for entire subsidiary. Entire subsidiary. Okay. So I assume the book value, we gave the book value? No, fair value. Okay. Of asset is 60 million. assume. Okay, so that means additional value of asset is 20 million. Why? Because the fair value is 80 million, book value is 60 million, so additional value of the asset is 20 million. Okay, now you can plot the entry. Okay, book value of the asset is 60 million, that means the equity in subsidiary is 60 million. Okay, so equity in subsidiary we need to debit how much? 60 million. Okay, then we go one by one. Okay, investment we need to debit investment in subsidiary. Sorry, it is not debit, it is credit. How much? 75 million. Okay, goodwill account is debit, which is 20 million. Okay, then NCL credit, non-controlling interest, NCI credit, which is 25. Okay, 80 or what is, and the fair value of the asset, and asset value we need to increase, which is 20 million. If you see, the total is tallied. Only this concept you need to keep in mind. Okay, we just revise. Okay, 75% we purchase for the 75 million. So fair value of the subsidiary is 100 million. Okay, so 100 million is the fair value of the subsidiary, and the fair value attributable to parent company is 75 million. So NC non-controlling interest is 25 million. Okay. Fair value of the asset is 80 million. So goodwill is 100 minus 80, 20 million. Book value of the asset is 60 million. Book value of the net asset is 60 million. That means the equity is also 60 million. Okay. In a subsidiary. Okay. Okay. So then equity in subsidiary, I reverse it, means we are not showing in a consolidated financial. Investment in subsidiary, that also we need to reverse because we are not showing in a consolidated financial. Goodwill we need to create, non-controlling interest we need to create, and the fair value, I mean the book value of asset we need to increase, we need to bring it to fair value of the asset, so which is 20 million. Okay, so this way we need to tally. Any doubt here? No. Then foreign currency terminology. Okay, so you need to understand. Exchange rate. What is exchange rate? Indian 80 rupees equivalent to 1 USD. Okay. Okay. So Indian 80 rupees is equivalent to 1 rupee, 1 US dollar. Okay. What does it mean? I can buy 1 US dollar for 80 rupees. Okay. So if I'm giving a quote with reference to the foreign currency, for US 80 is foreign currency. Okay. So that means it is basically the direct method. Sorry, foreign currency. Yeah, 1 US dollar, 1 euro cost 1.47 US dollar. Yeah, so 1 US dollar, in 1 US dollar, I can buy 80 rupees. So that is my direct method. Okay. And if I give in a foreign currency, means I can buy 1 US dollar, okay, for 80 rupees, then it is no, for 80, one of the same statement. Okay, so 1 divided by 80. 0.0125. Okay. US dollar to buy 1 rupee. Okay. So this is basically the indirect method. Okay. So if you are using a local currency as a one, okay, so that means it is indirect method. And if you are using a local currency, foreign currency as a one, that means it is basically the direct method. Domestic price of one unit of another currency, that is basically the direct method. So if you are considering one unit for a foreign currency, then it is a direct method. And if you are considering one unit of domestic currency, then it is basically the indirect method. Current exchange rate is the exchange rate at current date or immediate delivery of currency, often referred to as the spot rate. Okay, so like why we need to use the exchange rate? When transaction currency different from the reporting currency. Okay, so then we need to use the exchange rate. Say for I purchased the goods worth 1 million euro. Okay, but I am maintaining my record in a US dollar. So I need to use the exchange rate. Okay, okay. If I use the exchange rate which is prevail on a current date, that is basically the current exchange rate, and which we called as a spot rate. Historical exchange rate. The historical exchange rate is the rate in effect at the date of issuance of stock or acquisition of the asset. Asset we acquire on Jan 25, and now we report or we prepare the financial on 31st December 2025. Okay, so generally we asset, particularly non-current asset, we gave in the number at a historical rate. Rate. Okay, so whatever may be the rate prevail in the January 2025. So in the financial, current asset we are going to reinstate, but the non-current asset we generally record or publish at a historical rate, means the rate prevail on the transaction date. Weighted average rate, this we are using mainly for the PNL. So weighted average exchange rate is calculated to take into account the exchange rate fluctuation for the period. It would be impractical to account for the actual exchange rate in effect for the numerous recurring transactions sale. The average rate when applied for the transaction normally assumed to have occurred evenly throughout the period, approximate the effect of separate transaction of each item. So what happened if I record the sales at a different period and the total sale is 1 million euro? So I cannot consider the exchange rate prevail on a particular sales rate. Okay. So what I supposed to do, whatever may be the 1 million and whatever may be my average exchange rate. Average exchange rate calculation is differ from company to company, but generally in the month of January it is say for 1, then 1.2, then 1.1. So we take an average every year's every month exchange rate and then divide by 3 like this. Okay, we calculate say for here 1.15. This is my average exchange rate. Okay, so I need to use this for a converting from reporting currency to functional currency, or we will discuss that. But whenever we need to report, we prepare the financial in one currency and now we need to report in another currency. So we need to use the, for PNL conversion, we need to use the average exchange rate. then denominated in a or fixed in a currency. A transaction is denominated or fixed in a currency used to negotiate and settle the transaction either in US dollar or a foreign currency. Okay, so fixed in currency means like how I can say, uh, like if the transaction we record in a foreign currency and we need to consider the fixed exchange rate. Okay, particularly this kind of situation arises when there is a spot transaction. Okay, um, see, okay, fix in a currency used to negotiate or settle the transaction. Okay, so that we need to fix exchange rate, that we need to negotiate with the other party, and then we need to fix it out. Okay, and accordingly, we need to use this exchange rate for the conversion. Say for in a swap transaction, see the exchange rate fixed on a particular date. Okay, and now you need to just use that exchange rate for the conversion of liability. Swap transaction is basically, okay. So here what happened? There is a means you took a loan in your local currency and the other party take a loan in their local currency, and then your loan transferred to him and here loan is transferred to him. So your EMI obligation in your local currency, but the loan is basically in a foreign currency. So that's why the whatever may be the like exchange rate we fix at the time of start of the contract, this is basically carry forward. Okay, so see what happened, you may need a loan. You are an Indian and here is a US citizen. Okay, so you need a loan of 800 US dollar and they need the loan of 10 in their in both local currency. So in that situation what happened, he took the loan of 8,000 US dollar and then transfer 8,000 US dollar to him. Okay, and he take the loan of 10 lakh and then transfer the 10 lakh to US party. Okay, and then they are paying their local EMI. So it is basically the fix. Reporting currency. The reporting currency is the currency of entity ultimately reporting financial result of the foreign entity. Okay, so I mean generally it is the local currency of the foreign entity. Okay, so reporting currency is basically I mean in which currency you are preparing the final financials. Okay, functional currency. The functional currency is the currency of the primary economic environment in which the entity operate, usually the local currency or the reporting currency. Indian company, they engage in an export. Okay. So they are getting an amount in a like say for engage in an export to Europe. Okay, so they are getting an amount in euro. Okay, they expense out from this euro in INR, and as they are the subsidiary of the US company, so consolidation done in a US currency. Clear? Okay. So there are three currency. One is euro, INR, and US dollar. Okay. So US dollar is basically the reporting currency. Okay, because you are issuing a final report in a US dollar. Okay, euro is basically because your source of major income is basically your functional currency, means the currency in which your major transaction happened, that is functional currency, and INR is your local currency. Okay, so if the functional and local currency is different, then you need to convert, because see, in Indian company they mostly prepare the financial in INR. So first you need to convert your financial in a functional currency, and then you need to convert the financial in a reporting currency. That you need to keep in mind. Okay, so functional currency is basically in which the company operate more. So functional currency is the currency of the primary economic environment in which the entity operate. Usually the local currency or the reporting currency is a functional currency, but it may possible that because see, we mostly do the local business, but it may possible we are supporting to our parent company. So that's why it is given the local and reporting currency. But it may possible that we are catering the other market, local, beside local and the head office or parent company market. Okay. So in that situation, functional currency could be different. Foreign currency translation. So foreign currency translation is the restatement of the financial statement denominated in the functional currency to the reporting currency using the appropriate rate. Okay. So as I said, local to functional and functional to reporting. Okay. So this process we are calling as a translation. Okay. This process we are calling the remeasurement. Clear? We prepare the financial in a local currency, but my functional currency is different. So I need to transfer the financial from local to functional first, and then functional to reporting. Okay, like this. Foreign currency remeasurement, which we just saw. So foreign currency
So,
remeasurement, yeah,
your screen got stuck, the other one.
screen,
It is not visible, the content.
screen is not visible again because I am able to see the screen. Oh, oh. Is everyone facing the same problem? Okay, it gets stuck. Just a minute. The screen is get stuck. Okay, understood. Just give me 2 minutes. अरे ते हँग झालं परत. लवकर ये. काय आलंय इथं? काय करतो तू? हे मी केलं ओपन न्यू लॅपटॉप.
इथं गेलो ना आपण
हा.
एक वेळा इथं ह्याचं
चालू करू. Yeah, no, I think it is stable. Okay, so okay. So direct method, indirect method, maybe you are able to understand. Direct method, okay. So in direct method, what we are going to calculate, what is the price of domestic currency, okay, or how much I need to pay in a domestic currency to acquire the foreign currency. Okay, so say for if I consider the Indian rupee as a domestic currency, okay, so I need to pay 80 rupees to acquire 1 US dollar. Okay, so this is direct method. Okay, Indian rupee is basically the local currency. Okay, indirect method, how much USD I need to spend to buy a local currency. So it is 0.0125 approximately for 1 INR. Okay, so that you need to keep in mind. Current exchange rate is basically whatever the rate prevail on the date. Okay, so it is basically we can consider the spot rate. Historical exchange rate is basically when we purchase the asset. Generally we use the historical exchange rate for the reporting, we are using for conversion of the financial for the non-current asset. Purchase asset on January. Okay, so the rate prevail on those date, and when we convert the non-current asset, okay, we use the historical rate. Okay, there is a certain exception, but non-current asset, non-current liability, we use the historical rate. Okay, current asset, current liability, we use the closing exchange rate. Exchange rate, and for P&L item, we use the weighted average rate. Average rate that you need to keep in mind. So historical exchange rate we generally use to convert the current non-current asset. Okay, so historical exchange rate is the rate in effect at the date of issuance of stock or acquisition of the asset. Okay, weighted average rate that we need to calculate, that we consider for the P&L item, and we generally calculate say for in a first month it is 80, in a second month it is 81, and the third month it is 82. So average or weighted average rate is 81. Denominated in a fixed currency. So generally what happened, particularly in a swap transaction, where the rate is originally decided or determined. Okay, so that we need to denominate it in a fixed currency. Reporting currency, functional currency, and local currency. local, functional, and reporting. Reporting mainly the holding company's currency or the currency which we use for preparing the consolidated financial statement. Holding company currency, or we use the the currency which we use for preparing the consolidated financial statement. Local currency, financial, we prepare the financial of subsidiary. Okay, generally the local subsidiaries financial prepare in a local currency. Functional currency is basically the currency which we use for a transaction. So if I have 100% sell in a European country, so euro is my functional currency. Functional currency. Okay, just imagine my sale is 1 million and this is in euro. Okay, and equivalent loan I took, means whatever may be the exchange rate. Okay, so the say for I took loan in a Japanese yen. Okay, and equivalent to euro is basically the 2 million. So in that situation, my major business activity depend on this currency. So that's why my financial currency is this one. Okay. So when you are using a currency which is more frequent, that is your functional currency. Okay. But if all the expenses we do in a local currency and there is a export, a continuous export in a euro basically, so we need to consider this as a functional currency. Functional currency means the currency which we use mostly in a business. Okay, so that is my functional currency. Okay, now whenever we transfer the financial from functional currency to reporting currency, we called it as translation. Okay, basic financial of subsidiary we prepare in the local currency. So whenever we transfer from local currency to functional currency, it is basically the remeasurement. Clear? So these are this process, remeasurement and the translation. Okay, so we saw the translation. Foreign currency translation is the reinstatement of the financial statement denominated in a functional currency to the reporting currency using the appropriate rate of exchange. So foreign currency remeasurement, remeasurement is the restatement of the foreign financial statement from the foreign currency to the entity's functional currency in the following situation. Reporting currency is the functional currency, and the functional statement must be reinstated entity's functional currency prior to translating the financial statement from the functional currency to the reporting currency. Okay, if reporting currency is the functional currency, in that situation also we need to do the remeasurement. Okay, and the functional financial statement must be restated in the entity's functional currency prior to translating the translation. Okay, so here we need to do the first remeasurement activity. Monetary terms, asset and liabilities that are fixed or denominated in dollar regardless of the changes in specific prices or a general price level. So that is basically the monetary items. Okay, see, monetary items, I mean, in a simple words, the current asset. Okay, these are basically the monetary item. Okay, excluding inventory. Okay, we just need to collect the money like this. Okay, so asset and liabilities that are fixed or denominated in dollar regardless of changes in specific prices or the general price level, means now there is no valuation is required. Okay, non-monetary item, asset and liability that fluctuate in value with the inflation and deflation. So that is basically the non-monetary item. That also you need to keep in mind. non-monetary. Okay. Account receivable, whatever the amount you want to recover from customer, irrespective of the time period, the same amount you need to recover. So that's why we called it as a monetary item. Okay, there is no fluctuation in a amount. Non-monetary valuation. Okay, non-monetary item building. Okay, that prices of the building get changed with respect to passage of time. Prices of asset get changed with respect to passage of time. Okay, these are basically the non-monetary. So you need to keep in mind, because the exchange rate which we need to apply is different for the monetary item. As I said, we need to use current exchange rate for monetary item and historical exchange rate for non-monetary item. Okay, so generally non-monetary item is non-current asset, non-current liability, and monetary item is current asset, current liability. There is a separate in remeasurement. There is a separate approach to value the inventory. Okay, so that also we need to look into it. Okay, so inventory may be an exception. Otherwise, all current asset we need to recognize as at a current rate. Okay, and all non-current asset we need to recognize as a current non-current asset or non-current liability. We need to recognize at a historical rate. So you can see the cash is monetary, marketable common stock is non-monetary, bond non-convertible non-monetary, monetary, account notes receivable and allowances, that is monetary. Inventory is basically the non-monetary because the prices may get changed. Long-term receivable monetary, investment in subsidiary non-monetary, property plant and equipment non-monetary, and the tangible asset patent and trademark is non-monetary. Means where the valuation may get changed, that is basically the non-monetary, and the where the valuation is fixed, that is basically the monetary. So accounts and notes payable, it is monetary, accrued expenses monetary, and the bond and notes payable again monetary. But deferred charges and the credit, that may get non-monetary. Equities, these are all non-monetary because the prices are not get changed, and the retained earning is basically the plug number. Okay. So then step by step approach for the translation. Okay. Translation we need to do from functional currency to reporting currency. If we are converting financial from local currency to functional currency, then it is remeasurement. Okay. But if you are transferring from financial from functional currency to reporting currency, then you need to translate. So before performing any part of the translation process, it is necessary to ensure that the financial statement expressed in the foreign currency were prepared in accordance with the US GAAP or IFRS as appropriate. If necessary, correction must be made to comply with the GAAP or IFRS. So before you start for the translation process, you need to make sure that your existing or the standalone financials in an it's according to the US GAAP, because you are consolidating for the US company. Then determine the functional currency. The functional currency of a foreign entity determine the conversion methodology to use. So functional currency can be the entity's local currency, the currency of the reporting entity, or the currency of another country. Okay, so if you can see. Local reporting, and the third other one. Okay. If you do the business in India, procure the material in India, there is no loan outstanding or loan also you took in India, then INR is your functional currency. It is local as well as functional. Because every commercial transaction you are doing in an INR. Okay. So that's why your functional currency is INR. Reporting means you are buying, you are manufacturing for your group company only. Okay. So your, I mean, see, highest revenue is basically the sales. Then second one is loan. Okay. And then the purchase and everything, expenses. So if your entire sale is from the US, that means entire sale is denominated in a reporting currency. So that reporting currency will become your functional currency. Okay. Other means if you are not you are entirely export to the Europe. Okay, there is no loan or support you are getting from the local or from the headquarter. Okay, so in that situation, because your highest amount you are receiving in a European currency, and then you are converting and doing an expenses. Okay, so this is basically the functional currency. Okay, so this way you need to do. Okay, so I hope you are able to understand difference between the local reporting functional and the reporting. Local is basically prevail in the subsidiaries country. Functional is basically whatever may be the highest level of transaction you are doing in a particular currency. Okay, so that is basically the functional currency, and reporting is basically the currency in which you are preparing the consolidated financial statement. Okay. Okay. Under the US GAAP, if entity's local currency qualifies as a functional currency, it is the currency of the primary economic environment, means the maximum transaction we are doing in a local currency in which the company operates, and all of the following condition exist. So foreign operation are relatively self-content and integrated within the country, means everything, finance is from India, sale is to Indian customer, buying is from the Indian customer, then you can consider the local currency as functional currency. The day-to-day operation do not depend on the parent or investor functional currency, means you are not you don't require any loan or the equity infusion for the from the parent or other entity. And the local currency of the foreign entity is not highly inflationary, which is defined as cumulative inflation of 100% over 3 years. Like I mean, the if Indian currency is 80, okay, within 3 years it is become the 160. So it is basically the inflationary in nature. So in that situation you cannot use that currency. Okay. Then determine appropriate exchange rate. The functional currency of the foreign entity determine the exchange rate to be used in converting account balances and the treatment of the gain and losses associated with the translation process. Okay, so when you start the translation process, as I said, functional currency to reporting. Okay, we have a 2-3 type of transaction. Reporting. Okay, one is current asset, current liability. Okay, non-current asset, non-current liability. Okay, and the P&L item. Let's see. Parent company reporting currency equals to functional currency. Okay, so we just need to do the remeasurement. Parent company reporting currencies, foreign subsidiary equals to foreign currency and the equals to functional currency. Okay, so then you need to do the translation. Parent reporting currency So here the foreign subsidiary foreign currency and the functional currency is again the different one. So first you need to do the remeasurement and then you need to do the translation. Okay, so if you see, when the foreign subsidiary, the reporting currency is the functional currency and the remeasurement method must be used when the foreign subsidiary is highly integrated with the parent and serves primarily as the sales outlet for the parent. Day-to-day operation of the subsidiary depending on the reporting currency. So foreign subsidiary operate in a highly inflationary and the foreign subsidiary operate in a highly inflationary measure. So foreign subsidiary, the reporting currency equals to functional currency. Okay, so I mean, we are using a functional currency as the reporting currency. Then you just need to do the remeasurement. Okay, you are preparing the financial in a local currency, and then your functional currency and the reporting currency is same. Then you need to do the remeasurement only. When the parent company reporting currency, so translation, foreign subsidiary, foreign currency equals to functional currency. Means the local currency is basically the functional currency. Okay. When the functional currency is the reporting currency, then you need to do the remeasurement. When the functional currency is the local currency, and you just need to convert in the convert in the reporting currency, then you need to do the translation. Okay, I'll just write. Functional currency is equals to reporting currency. Then do the remeasurement. Okay. Functional currency equals to local currency. Okay. Then you need to do the translation. Okay. And if there is a difference, then local currency to functional, this required the remeasurement, and functional to reporting. Then you need to do the translation. Okay. If you do the functional currency to the reporting currency, then you need to do the translation. Here the functional currency is the local currency. If your functional currency is reporting currency, so then you do not require to do the translation. You just need to do the remeasurement. Means local to functional, functional to reporting. Okay, so if you go local to functional, then you need to do the remeasurement. Luckily, the functional and the reporting currency is same, so translation is not required. If you go from local to reporting, okay, so then you need to do the local currency is your functional currency. So in that situation, you do not require to do any remeasurement because you are already maintaining the financial in a functional currency. So you just need to do the translation. When local to functional is different, then you need to do the remeasurement, and functional to parent company, you need to reporting currency, you need to do the translation. Here what happened, the foreign functional currency is the reporting currency. Okay, so that's why you just need to convert from local to functional currency. Okay, as there is no change in functional and reporting currency, so translation is not required. In the second case, only we need to do the remeasurement. Local currency is functional currency, so local to functional process is not required, so there is no need for remeasurement. Functional to reporting currency we need to do, that is basically the translation. And all three currencies are different, so local currency to the functional currency we need to do the remeasurement, and functional currency to the parent currency we need to do the translation. Okay, so just need to keep in mind local to functional, functional to reporting. Okay, so as local currency is my reporting currency, okay, so I do not require to functional currency, so I do not require to transfer from local to function. So remeasurement step is skip. Okay. Now I just need to do the functional to reporting. So I need to do the translation. Second case. In first case, reporting currency is basically the functional currency. So I need to first convert local to functional. I need to do the remeasurement, but I do not require to do the functional to reporting because both the currencies are same. So translation process gets skipped. Only I need to do the remeasurement. If all three currencies are different, so first I need to do the local to functional with a remeasurement process, and then functional to reporting with a translation process. So local to function, function to reporting. If any process, means if I find local equals to functional, then remeasurement gets skipped. If I find functional equals to reporting, then translation gets skipped. Now remeasure method, which is called as a temporal method as well. So temporal method generally used in an this word used in an examination. Okay, so you just need to keep in mind. So in the remeasurement method, what would be the conversion factor we need to consider? Balance sheet, monetary and non-monetary. Monetary, current year end. Monetary means the current asset, current liability. Non-monetary means asset mainly. So historical rate. So keep in mind, inventory is considered as a non-monetary. Okay, so that also you need to understand. Then income statement, no balance sheet related item, weighted average rate. Okay, non-balance sheet related item, weighted average rate. Balance sheet related item, historical rate. Okay, so like depreciation, cost of goods sold, inventory. Inventory we consider as a non-monetary and we apply the historical rate. So anything related to the inventory, we again require to apply historical rate. And the amortization, bond and intangible. So that is also related to the fixed asset. So we need to use the historical method. In income statement, for any non-balance sheet related item, we need to use the average rate. But if anything related to the balance sheet item, then you need to use the historical rate. Remeasurement, gain and loss, income statement. Plug currency gain and loss to get the net income to required amount needed to adjust the retained earning in order to make the balance sheet balance. Okay. So in remeasurement, we recognize the forex gain loss only at at one place. In a translation, we need to use for a two place. We will see. Current and historical. Okay. In P&L, it is historical. Asset depreciation, we need to convert with a historical method because asset also we are converting with a historical method. Okay. Other